Hi, I'm Harry Papp. I'm Vice Chair and Chair of the Investment Committee. And so I've been doing this a long time. We've been at it 41 years. I'm the managing partner of a little firm here in Phoenix. It has about $1.1 billion under management, roughly 500 clients. They vary soup to nuts all over the board. Some are small. We probably should never have taken them. Others are phenomenally wealthy, but we deliver pretty good service for all of them. Our little firm, we are fundamental active managers. We're not very active. We try to buy a stock and hold it for 20 or 30 years and avoid paying capital gains taxes. But what we're doing here is very different. It does not make sense for us to buy individual stocks. We're buying funds and things like that, but the factors are the same. And in any event, I'm going to move us on to talk about performance. You heard Mike say that we were down. So almost everything we report is on a fiscal year on June 30th. You heard Mike say earlier we were down negative 4% last year. I've got 1.85% here. It depends on how you value and at what time frame you value private equity. And over a long period of time, 3, 5, 10 years, everything comes out in the wash. Right now, we're in a market environment where things change dramatically day to day. For example, in late January, early February, the interest rate on a 10-year Treasury got down to 3.33%. Today it hit 4%. So it's quite a difference. We'll see markets up 5.5% in the month of January. We'll see markets down 3.5% in the month of February. So we're seeing wild gyrations month to month. And when you compare a benchmark, that's publicly traded assets that change every day, and you compare that to private equity, where it's valued every 3 months and on a 3 or 4 month lag period, it really makes a difference what time period you're looking at. So the best apples to apples comparison we can give you for performance for the fiscal year ended June 30th, 2022 was minus 1.85%. And we were in the top 11% of public pension plans. So I'll just tell you, if the Arizona Cardinals were in the top 11% of the winning percentages of the football games this year, if they were in the top 11% for the last 5 years, they'd have 4 Super Bowl titles. The top 11% is, it's almost impossible to do that well. The reason we did well, and we did it, we had a terrific return, 27.8% in the fiscal year ended 2021. The real driver is the things that we don't own. Historically, a public pension plan typically has had 35% of their money in bonds, in long bonds. We had 3.5% or 2.5% of our money in bonds that did not do very well. Our stocks went down, but our stocks are coming back up. The bonds are not, in my opinion, are not coming back. I think there's been a quantum shift in inflation and interest rates. And if that's true, that's really going to be a problem for the bond market. So the investment committee, we have 4 members on the board, on the 4 board members on the committee. We're fully staffed. When we look at the portfolio volatility, we have a relatively sedate mix of overall risk. We monitor this very carefully. I would invite all of you to, we have monthly meetings of the investment committee. They're available online. They last an hour, hour and 15 minutes. You'll hear a lot the first maybe 15, 20 minutes about market conditions and about how we're doing and how we're allocated. So if you're really interested in where are the investments, what are we doing, you can, it's pretty easy to tune in on that, and it ought to be pretty user-friendly. So anyway, our overall volatility is pretty well controlled. And this is different. I will tell you that the portfolio is very, very different today than it was 6 or 7 years ago. And part of it was the PBI. Essentially, if you go to Las Vegas and you bet that a little ball is going to drop in a red slot, you keep doing it, I guarantee you, you'll have no money because the odds are against you. But if you played roulette and if you won, you got to keep half of your winnings, but if you lost, you get to keep 100% of your losses, you'd lose money even faster. And that's how it was with the PBI. It incentivized the PSPRS not to take risk. So unfortunately, during a period where the market did very well over about 10 years, we didn't have enough risk, but it was due to the PBI. That's been corrected. So the portfolio is well controlled, it's diversified. We'll look in a little more detail in a few minutes. Our process is fully integrated. We are, again, things are well controlled. Expenses. Expenses are really important, particularly in a period where you have, historically, we've had very low interest rates for the last 10, 15 years. And when you have low returns, expenses are even more important because anything you spend is something else you don't have at the end of the day. Mark's got a slide later on. You'll be amazed. The value of the assets has gone up dramatically, and the expenses of the investments have gone down dramatically. That's a very good thing. Outlook, they pulled this out of last year's meeting. And somebody we were talking about, nobody told you the market wasn't going to do well last year. I think what we said last year was inflationary pressures combined with security prices that are at all-time highs means the near-term expectations are modest. Well, that's pretty accurate. And I will give the investment team a lot of credit for having seen the inflation. Anybody noticed inflation? Stuff costs more? It's a big deal. Somebody said earlier today, you know, the inflation could be here for 2 or 3 years, 4 years, but it's temporary. It's going to go away. Yeah, unless it doesn't. And we can look at the fundamentals and try to make some determination of whether that's likely or not. And for the longest time, we were getting nothing on the money market fund or on short bonds, but we were not losing anything. Today, things have changed dramatically. We can buy a 1-year treasury and get a 5% return. Now, that's not 7.2%, which is what we need, but 5% is a heck of a lot more than 0%. And that's exactly what we're doing with an awful lot of the short-term investments. So if we talk to our consultants, they would tell you that last year's poor returns in the market means that we're starting at a lower level, and therefore our expectations for returns on risk assets are a little higher than we would have figured a year ago. And that's, for the long term, that's probably a good thing. Now, do we want to win this month? Yes. Mm-hmm. Do we want to win next month? Of course. Do we want to beat ASRS? Well, we like ASRS, but of course we want to beat them. We want to beat them every month. We want to do the very best. That's not really what we're doing. What we're after is to get a good total return over a long period of time and control the risk. If we have massive up years and massive down years, your employees will see their contributions go up and go down. Is that helpful? Not at all. We want to stabilize that. So there's a lot to managing this portfolio. Here is the portfolio. This is the asset allocation. About 90% of the returns that a portfolio is going to bring to you is determined by the asset allocation. So this is really important. And Mark and his team have taken an approach that's pretty different from most. Rather than looking at just equities or bonds or private investments, they've divided up the types of assets into what are we trying to achieve with them. So the first one is capital appreciation. And we're trying to buy stuff, invest in it, hopefully hold it for a long period of time, but we're trying to buy stuff that will go up in value, capital appreciation. That's certainly the U.S. equities, the international equities, it's private equity, it's opportunistic real estate, where we're not just buying a piece of real estate to get the rent, we're buying a piece of real estate where there's some opportunity. Maybe we can expand it, maybe we can remodel it, maybe we can repurpose it, maybe there's something we can do to drive additional value. High yield bonds. Now, most people would look at bonds as, in the bond category, the contractual income. That's not how we look at it. We don't have any high yield bonds today, but if we did, that's where they'd be. And the high yield bonds are a little more sensitive to the economy, and they think of them as 70% a bond, 30% a stock. So it's in the right category here. We also have emerging market equity. We don't have very much of that. And emerging market bonds. We don't have, I don't think we have any of those. Contractual income, all we're trying to do there is give somebody our money, make sure they're going to give it back to us, and hope that, and want them to pay us a pretty good return on that. And that's treasuries today at 5%. It's investment grade bonds. It's private lending. We do an awful lot of private lending. And I'll just distinguish, so we will have another recession in the United States. I don't think it's going to be this year. But when we have a recession, some of the folks may not pay back their bonds. They may go bankrupt. They may have some troubles. Right now in the high yield bond market, because interest rates have been so low for so long, people in high yield bonds are able to borrow. The investors were so eager to get higher interest rates that they would loan money to folks that really were not all that likely to pay them back, and there weren't any loan covenants and restrictions on the borrowers. And that's different. The private debt that we own has all kinds of loan covenants and restrictions. If we loan money, if one of our managers loans money to a company and the company wants to do something, raise salaries, acquire another business, borrow some money, all of these things are things that might cause the borrower not to be able to repay us. And our manager has the right to say, it's a great idea. No, we're not going to let you do that. We're not going to let you do things that will cause us to maybe not get repaid. And we're now seeing lots. So I'll tell you, if you own high yield bonds, I'll tell you a couple of things about the people that issue the bonds. If they're high yield, they're a crummy credit quality. They're also all variable rate. So you've got a highly leveraged company that is all variable rate debt, and you know interest rates have gone from 0 to 5%. This is a poster child for a company that might have some stress. They might have trouble paying you back. We'll have some bankruptcies. We'll have some problems with private lending, but we will recover an awful lot more because of the restrictions and the way that these funds are run. We also do leasing and royalties. These, again, are contractual incomes. Typically, we're getting more than our 7.2% hurdle rate on these, and it's contributory towards the total return. We will have some bumps in the road. We know that, and we're being careful about that. We also have diversifying strategies. Think of hedge funds, global tactical asset allocation, merger arbitrage, long short. These are hedge funds. We don't have very much in that. I think you can see from the pie chart that the diversifying strategies in total are about 6%, and I'm sorry, about 9%, and those are probably headed lower. Those made a lot of sense over a long period of time when you could earn basically nothing in bonds. Now that you can earn 5%, it doesn't make an awful lot of sense to be invested in that area. They're also illiquid. They're also very expensive to operate. They use an awful lot of staff time because If you just buy the Russell 3000, that's pretty easy. If you try to deploy private equity, private debt, hedge funds, you better know what you're doing, otherwise you're going to get in a lot of trouble. So let's look at portfolio performance. So June 30th, you can see the down 1.9%. Our assumed rate, somebody mentioned that we reduced that this last year from 7.3 to 7.2. We may well reduce that to 7.1 or 7.0 in the coming years. We'll just have to see. But you can see we also we have a 7-year smoothing period. Did I mention you guys don't like to see firefighters and cops having their contributions jump around? It's up 1 year, it's down the next. So we take an average over the last 7 years, and that smooths out the ups and the downs. And you can see over 3 years, 5 years, 7 years, 10 years. With 7-year, we're slightly below. 5-year, we're slightly below. But overall, we're doing pretty well at the 7.2% assumed rate. I will point out that in the past, particularly 10 years ago, 12 years ago, we had a lot of joint venture real estate holdings that did not perform very well. That is over. We've got those all under control. Almost all of them were sold this last year, most of them at a very substantial profit. So we've done a really good job the staff's done a really good job at managing those much more effectively. And it's not an area we're going to go back to. It's an area where it's very difficult to operate. We'd rather hire a good real estate manager and give them the assets. We can evaluate how they've done the last 20 or 30 years. We can look at their track record. We can talk to them. And we'd much rather hire them, buy a pool of assets so that's diversified, rather than buying a particular property here or there. So the returns, this is gross of fees. The fiscal year to date, this was through, I guess, January 31st, up about 4.2%. I'm going to guess we've probably lost 1.5 or 2% of that during the month of February. So again, the markets are very volatile. As a little later on, I'll touch on what's driving the volatility and what we expect going forward. So the investment committee, our primary task is the asset allocation. We look at market conditions. Staff monitors what's going on in the markets globally. We have consultants. NEPC is our board fiduciary consultant. Basically, before we deploy investments, we have a specialty consultant. We have staff that reviews it. We have specialty consultant that reviews it, and we have the NEPC that reviews it. So as long as staff goes along with it, and the specialty consultant and the general consultant all go along with it, then we'll go ahead and make that investment. But we're very careful as we do that, particularly on the things that are illiquid. Again, the Russell 3000 or a 6-month Treasury, you can buy those all day. You really don't need a lot of expertise. You need to figure out what to do, but implementing and executing is not difficult. The other assets, the private equity, private debt, those you really better know what you're doing, or you're going to get yourself in real trouble. So the board works with NEPC. They present to us, and staff presents to us, and together we come up with an asset allocation, which again is going to drive most of the returns. The investment staff is charged with monitoring day-to-day activities and making sure that things are performing as expected. And if not, we push back, we make changes. So the specialty consultants, we've consolidated these. We had 3 before, 4, I guess, before. Allborn, which is well-known in the industry. They advise an awful lot of public pension plans. They are reviewing the individual investments. They monitor the existing investments. We also still use ORG, who had been our real estate advisor. They're continuing to help us on the legacy real estate, and they've done a spectacular job for us. You may know that we had an outside firm. We parted company with them several years ago. We went to ORG. ORG set us up with one of the managers who came in and very successfully managed this portfolio. I will say it hasn't been easy. The investment staff and the committee had to spend some time and energy making sure we got a good ultimate result. But we got a great result. The results are beyond my wildest expectations. So it's a happy conclusion to a really sad story over the years. So then the investment committee, again, tasked with coming up with the asset allocation. We're going to be working on that in our March and April meetings. And again, the meetings are open to the public. We'd encourage you, I mean, it's your money. We're handling this. We're doing the best we can. But if you want to know what we're doing, why we're doing it, how it's performing, tune in for 15, 20 minutes or an hour. We publicize when the meetings are, and we'd be happy to have you call in. You can also, I don't know that we've had a call from the public lately, but if you've got a burning question and you think we're doing something crazy, hit the chat function and we'll talk. So the key committee presentations, we look at monthly performance. Did I mention we like to win? We look monthly, quarterly, fiscal year to date, calendar year to date, 1, 3, 5, 7 year, 10-year performance, and we look at it by asset classes, and we break it down further into the components. This is the risk analysis. It's wonderful. I could tell you, we got this great investment. We gave Mark $5 million. He came back a week later, and he brought us $9 million. How did he do it? Well, he got on a plane, went to Las Vegas, he bet on a little ball, dropped in a red slot, and we had a really good return. You want us to do that with your pension? I don't think so. We can't just look at the return. We have to look at the risk that we're taking. And there are a lot of different ways to measure risk. And we break down the risk. Our consultants help us break down the risk and try to identify where we're taking risk and make sure we're going to get paid for it. So we have a monthly risk analysis. It's about 15, 20 pages. We have a global financial market update that looks at how various investment assets are doing compared to their central tendency over 3 or 5 or 10 years. Quarterly, we get a detailed performance review by the independent consultant. And again, quarterly, we have discussions about trends that are occurring in our industry. Annually, we review the portfolio asset allocation and come back to the assumed earnings rate. Key investment committee projects, investment book of record. I'm going to let Mark describe that.
Yeah, so the investment book of record really refers to the digitization of our front, middle, and back office functions. So the entire investment platform moves from more of an analog state to a digital state. And it's hard to describe. It's a little easier to do with examples. So when most pensions conduct due diligence, there's a number of reports and files that they're going to review. Typically, those are stored on your local drive. They're PDF documents. When you make an investment and your partners are reporting to you quarterly, they're sending you PDF reports. They all report in different formats, and you have to organize them on your S drive. So you can imagine if you have staff, analysts, and PMs who are trying to get to information quickly, they have to pull up PDFs, and they have to manually pull information out of PDFs. It's very low value add. It's very important to do, but not the way you want to spend your time. So part of this is putting all of the documents online and leveraging as best we can the advances in machine learning to scan the documents, file the documents automatically, and to make the search process easier so our team can spend less time trying to find the information and more time digesting and talking about the information. The other part of this is enhancing the reporting and performance reporting, risk analysis, and exposures for the portfolio. Most pensions, 99% of them, will get reports from their custodian. We use Bank of New York Mellon. The custodians grow up in accounting, and they're not very agile in terms of giving you the type of reporting that you want for your portfolio, especially if it includes holdings that are not stocks and bonds, the traditional stocks and bonds that you can get on exchanges. They'll typically only give you values as of the start of that day, which is difficult when you're trying to make a decision intraday if you have to, and you're trying to figure out what your profit and loss is. They don't handle multi-asset class portfolios very well. So part of the effort here has also been to modernize the performance and risk reporting. So we have third parties now that can go in and pull out underlying exposures. They can handle private equity, they can handle hedge funds, they can handle liquid securities, and it's all up to date. I can feel the question coming. I'll just disclose to you that ChatGPT did not write any part of this presentation. So while we wholeheartedly embrace machine learning and AI, it's not running amok in the portfolio. And take it from, I'm informed about this. I do have a degree in predictive analytics, so we're not running around with knives. But I did want to say that we're leveraging it where it's appropriate, but we also have a very healthy skepticism, and it's coming from a place of education, and we're informed about it. So where we can, we'll implement that to save staff time. And where it's not applicable, we're not going to do it just to say that we're doing it. So I'm really happy that that program is rolled out. It took a little bit longer than we thought. Last year when we reported to you all, we mentioned this. We thought it would be done by the end of December, but it took until March. So I'm happy that it's complete.
Great, thank you. Projects for this year, the cancer insurance plan is a very different pool of assets. It's an insurance pool as opposed to a pension plan. It's smaller. It doesn't have these other diversifying assets. It owns marketable liquid securities. It's doing fine, but we really don't have a very good handle on the liability stream, and that's because the people haven't been very aware of the program. We're fixing that. Brian Moore is going to fix that for us so that people know the benefits that they have. We're also looking at a way to administer that program much more cost effectively so that it serves the members much better. Once we have a good handle on what the liability structure is, then we'll come back and refine the asset allocation to match that. We're also we're going to be working on the asset allocation. That's the main piece of work at the March meeting and the April meeting. Next is, I'll give you my outlook for this year and perhaps next year. These are data from a couple of our consultants. NEPC, New England Pension Consultant, has about $1 trillion under advisement. They're pretty smart. They're assuming that large cap equities, that'd be Apple and Exxon, are going to produce about 5.4%. And this is over a 10-year look forward. Personally, I think it'll do better, but we'll see. U.S. private equity, they love that. So they're at 9.2%. I'm less optimistic about that. Private lending, 8.8%. I think that is maybe a little high as well. Emerging markets, emerging markets is an interesting concept today. Who thinks China is a good friend of the United States? Show of hands. Ronald Reagan, trust but verify. I mean, that's about the best you can do. When you say emerging market equities, just think any mutual fund that you have in your 401k or your 457B, any emerging market equities fund is 40% Chinese. And at our firm, we don't buy those. We think that's too dangerous, but we're careful on that. In any event, New England Pension Consultants is optimistic about it. U.S. real assets, those would be timber, oil and gas, gold, things like that. They have 6.6% real estate. U.S. bonds, they have 4.2%. Well, it's a 10-year look. I think the yields might be a little higher because I think there's going to be plenty of inflation. Right now, we can get 5%. In international equities, they have about 5.6%. J.P. Morgan's a lot more optimistic about large cap equities, international equities. They're across the board a little more optimistic, a little less optimistic on U.S. real assets and government bonds. So I think what's been driving the financial markets the last couple of years has been inflation. And you've all noticed the inflation. There's different kinds of inflation. There was inflation during the pandemic. People couldn't go on vacation. Some people couldn't get their beard trimmed. So they, instead of buying services, they bought stuff, pretty much on Amazon, and they had it shipped to their house. So the market for stuff was really hot. And eventually the costs of stuff went up a lot. Now, people are shifting back now. They're shifting back to services. And so that has taken some of the pressure off of the inflation on goods. The other part of inflation, though, is wages. We heard City of Tucson, they caught up after 10 years of not giving any raises, but giving 30%. Well, there's a lot of inflation in payrolls, in services, and we're continuing to see that. And that's the inflation I'm most concerned about. We call it cost push inflation or a wage spiral inflation. This is, I think last year I mentioned Walmart was paying $25 an hour for some people in New York City, and that sounds great for the guy that gets $25 an hour until he goes to buy bananas and cornflakes at Walmart. And in order for Walmart to pay him $25 an hour, they got to raise prices on cornflakes and bananas. And by the time he finds out cornflakes and bananas are more expensive, he's going to want $27 an hour. So you can get caught in this spiral of wages and prices. We know what caused it. It's the Federal Reserve. It's stupid fiscal policy in Washington. But it's also kind of like a forest fire. It's really easy to set a forest fire. You get a can of gasoline, some matches. Pretty soon, you're going to have a rip-roaring fire. Well, even if you knew what caused it, go ahead and put it out. Putting it out is not so easy. Starting, it's very easy. And inflation is the same way. So personally, I'm very concerned about inflation. We talked a little bit at lunch with some of my staff. And imagine, and they get paid more than this, but imagine they get paid $50,000 a year. We gave the rank and file people in our office a 10% raise last year. 10% on $50,000, $5,000. So they used to make $50,000, now they make $55,000. So they're $5,000 better off, right? No. They got FICA, they got federal taxes, they got state taxes. When they put it all together, they didn't get the $5,000, they got $3,000. The government got $2,000. The government's in the inflation business. Government benefits, it's a profit center for government to have inflation. And they have a big incentive to do that. If you owed somebody $31.5 trillion and you couldn't pay it back, one way to deal with that is to say, well, the 31.5 trillion is a lot, but it doesn't buy what it used to. That's inflation. So at my firm, we're very concerned about inflation. That's why we're staying in short bonds. That's why PSPRS is in short bonds. And that had a lot to do with spectacular relative returns. We know you can't pay pensions with smaller losses, but over time, it should average out. So we think the inflation is an issue. We think the higher interest rates are here to stay. I would observe over the last year, we've had about 6 different waves of enthusiasm in the financial markets saying inflation's almost over, things are getting better. Pretty soon the Federal Reserve is going to be cutting interest rates. And I think that's all nonsense. I think we're going to have higher interest rates for longer. That's what everybody at the Federal Reserve has been saying. When you look at all the data that's come out, CPI, PPI, unemployment rate, jobs created, everything's running hot. The economy looks pretty good to us. A lot of people forecast a recession in 2022. I can now tell you that didn't happen. If we can't have one in 2022, we'll have it in 2023. And now they're saying, well, maybe late in 2023. Well, I think it's unlikely we'll have a recession this year. I think the economy, the growth may slow a little bit, but I don't think we're going to have a recession this year. And if that's true, I bet you a lot of people are going to travel this summer. And if that's true, you won't be able to get an airplane ticket. Or if you can, it'll be expensive. And when you go to fill up your tank, it'll be expensive. And we call that inflation. So I think the market's got a little more adjustment to come to really understand that the Federal Reserve is going to keep rates higher for longer. The marketplace had been projecting interest rate cuts by the Fed later this year. They've pretty much cut that out lately. I think there's a pretty good chance that we won't see interest rate cuts in 2023 or even in 2024. And I think the economy will be pretty good. If that's true, corporate earnings will be pretty good, and maybe the stock market will be just fine. So these are the kinds of things that we talk about. We've got a terrific staff. We monitor market conditions carefully. We bake all of this into constructing the portfolio and managing the asset allocation. So, and this is my favorite graph, and a couple of caveats on it. This is a group called Ibbotts and Associates, and what they've done is they've monitored the various asset classes going back to 1926, and they've made the assumption that for U.S. corporate bonds, you put $1 in a corporate bond in 1926, you reinvest that every year, you pay no taxes, no fees, and at the end of, I guess that would be 96 years, that $1 in U.S. government bonds became $131. If you bought corporate bonds with some credit risk, that $1 becomes worth $257. If you bought large company stocks, that's IBM and Apple and General Electric didn't work out so well, but companies like that, that $1 would have become worth $11,000. And if you bought small company stocks, some of them were small companies like Amazon and Microsoft. They're not so small anymore. That $1 would have become worth $49,000. So for me, this is why I'm in risk assets. But we have to temper. We could put it all in risk assets. Back to little ball drops in a red slot. I know the risk is too high for us to put it all in stocks. And we wouldn't have to stop there. We could put the whole $19 billion in stocks, and then we could go out and borrow $10 billion and buy some more stocks. And we'd have an asset allocation of 143% equity and minus 43% fixed income. Who thinks that's a good idea? Not me. Anyway, we've got to control the risk, but this tells you why we're allocating the majority of our assets into risk assets. You just have to be very careful with them and monitor them closely. Next up is Mark. We are lucky to have him. I see an awful lot of chief investment officers at various programs. I see a lot of people. I'm involved with a lot of retirement plans and pension plans and endowments, and Mark is one of the very best. Don't tell him about the payroll next year, but we are really lucky to have him, and Mark's going to touch on a few more things.
Thanks, Harry. I don't have much to cover. I enjoy listening to Harry, and so he gets most of the time. I did want to just briefly report on the 4 priorities we have that are in our investment policies. They are in order of importance, the first one being hit the assumed earnings rate, and then do that with enough liquidity to make payments, manage the volatility for that level of return, and then do all of that for as little money as possible. Those are the 4 priorities. We already covered returns, so I won't dwell on that. Liquidity is very high. To the extent we look out 5, 10, 20 years, we'll have modest obligations out of the portfolio of 1 to 3%, and those are easily handled. We're already at 12% in cash and bonds, which is a great position to be in when you have markets that are really volatile like they are right now. That's really enabled the trust to execute on a lot of transactions and opportunistic deal flow, which is going to bode well for the long-term prospects. Volatility is typically measured by what we call a Sharpe ratio or a Sortino ratio, one being just general volatility and one being a measure of positive volatility. You don't want to penalize somebody for investing $10 and then turning it into 20, right? That's a volatile return, but that's a good kind of volatility. You can see here that generally speaking, we're doing a good job on a risk-adjusted basis. When you compare us with other pensions and you control for how much risk they're taking, some pensions might take more risk, some pensions might take less risk. So the risk-adjusted measures are your indication of generally kind of apples to apples instead of looking at just the top-line return numbers. Lastly, Harry mentioned the expenses. They are coming down. There's been a combination of I think, straightforward blocking and tackling, more cost-effective investments like more liquid investments, stocks, bonds, as opposed to more expensive alternatives. We're bigger now. When I started, we were about $10 billion. Now we're about $19 billion. So as you get bigger, you realize those economies of scale. Shrinking the asset classes was helpful too, because you're able to take bigger positions, and that enables you to take, to extract better economics. So it's just a combination of various measures, but we wanted to make sure we were clear on that. So performance has been good. I'll just end with this slide because my annual review is coming up, and our administrator's in the room. So this is my scorecard. This is my scorecard. I started September 30th of 2018. You can see higher numbers are worse. So when I started, the 10-year performance relative to our peers was in the bottom 11% of our peer group. So across all the major horizons, performance has remarkably improved. And I'm glad to talk about why that's the case, but you've all been very patient, so I'll stop there and take any questions that you have.
Mark, I'll go ahead and salt the tip jar. One of the things that's happened over the past several years is that employers have contributed billions of dollars in additional contributions against pension debts to PSPRS. The other day, we were asked by a reporter how that amount of money has impacted the investment portfolio allocation and thought process going forward. Could you elaborate a little bit?
Yeah. Was that the reporter that works for that? It starts with a W, it rhymes with
No, that
Wall
was
Street Journal? Okay.
pensions and investments.
All right, fine, fair enough.
It was a friendly one.
Okay, yeah, so one of the risks that we see in some pension systems is that you'll have a big loss, maybe a 10, 15, 20% loss, and you're paying out 2, 3, 4, 5% from the portfolio. At a certain point in time, that becomes a very negative self-reinforcing cycle. So you have issues of cash flow at the total plan level. You also have intra-year problems because we're buying and selling all the time. And when you have illiquid investments, you can't really time those as easily as you can time like buying stocks and bonds, right? So the problem you have is then an intra-fiscal year cash flow problem. And there could be a very sharp market dislocation like we had with COVID, where the markets blew out 20, 30% and then recovered in about a 2-week period, very sharp. And if you're cash flow negative, you can't really lean into that kind of dislocation. And that's just in the public markets. There's lots of pain to be had in private markets as well. So the contributions coming in has really given us a lot of liquidity at the exact time you want it. When markets are really volatile, there's lots of stress. So we were one of the few pensions, I think there was an announcement today, that actually grew assets last year at 13%. Now, our portfolio was a modest loss, so a lot of the asset growth came from the contributions. And that really enabled us to have liquidity to execute on a very attractive investment market. So I think long term, that'll be really good for the system. Harry, do you want to add?
No, I think we are very different than most other plans, and it's a partnership. The state of Arizona trusted PSPRS. They gave us $2 billion. I know some of them. Trust me, they wouldn't have given us the money if they didn't believe we'd be careful with it. And you all, an awful lot of the employers out in the room, they did two things that were very good. They borrowed a lot of money at 2.5%, and most of them gave us the money, which is great. If you didn't give us the money, that's all right. We're glad you borrowed it anyway, because you couldn't borrow at 2.5% anymore. That train has left the station. So it's been a partnership. You guys trusted us. We're in the top 11%. We're going to try to do better. I'm not holding my breath, but we're really careful about what we're doing. We could have taken that money and put it in the Russell 3000 and just core bonds. Boy, am I glad we didn't do that. We weren't smart enough, and we know we're not smart enough to look at our portfolio and say, oh, the market's going to go down 20%. Let's sell a third of the public equities. That's timing the market. If you can do that, good luck. I've been at it 41 years. I'm not that smart. But we were smart enough not to deploy the assets at a time when the market conditions were not very favorable. They're getting more favorable now, and over the next 3 or 6 months, I anticipate that we'll be able to deploy some of that. There are other things that we buy. Mark was talking about private assets, and you have to be very careful. In the industry, we call it vintage. If you buy an awful lot of wine from this year's vintage, you better hope it's a good year. You're better off if you buy a little bit each year for 10 years, and you won't get all of the great vintage, but you won't get all of the horrible vintage either. So when you buy private equity or private debt or some of these other more complicated investments, it's important that you don't just load up on it at one particular time. It's very complicated. In any event, the cash position, the liquidity position we're in, puts us in a really strong position. There are lots of folks that had a 15% decline last year. The average major public pension plan was down 12% last year. You know, we were down, or 11%. We were down 1.85%. When you're down 12% and you're paying out 4 or 5% because you've got negative cash flow because your employment base is not growing, all of a sudden, you've got 17% less money. And if you have a bunch of illiquid investments, oh boy, now you've got too much in illiquid. And if the market's down and the managers are calling capital, now you got way too much in illiquid investments. What do? You sell some of them in the secondary market. Well, you're going to take a haircut. And who are you going to sell it to? You're going to sell it to people that have plenty of liquidity, like us. What a great idea. So it puts us in a really strong position. Other questions? Yes.
You said earlier that you were elated over one of the investments. I believe it was about the real estate management part.
Yes.
Can you expound on that?
Sure. Historically, historically, public safety invested in some private real estate in Arizona. Primarily in Arizona. Some is in Texas, some is in Utah, but the bulk of them were in Arizona. And in hindsight, anybody ever heard you can't get hurt in dirt? Real estate never goes down. 2008 sort of settled that for us, and I think people are aware that real estate doesn't just go up at this point. In any event, in hindsight, there were some investments that were really not great, and they were not being managed very well. And we decided that things were not going well. We terminated the former manager, and we took on the remaining assets with the help of ORG and a firm called Miller Global. And it's very difficult to manage those assets. It's almost like renting a house. If you had an extra house and you were renting it, as long as the tenant just sends a check every month, that's fine. But what if they call at midnight on Saturday night and say the toilet's backed up? You want to get in your car? I mean, it's hard. There's an awful lot of things to do, and there are an awful lot of things that can go wrong. So our staff spent an awful lot of time the last couple of years getting control of those assets, and we've had some favorable developments. I will tell you, one of the properties had not done very well for a long time. And then some company built a campus close to this piece of real estate, and they hired a bunch of people that were paid pretty well. This company was called Apple, and that improved demand in that location. We hurried up and got that thing sold because when we sold it, the mortgage rates were 3.5% or 4%. Now they're 6.5%. If we owned it today, good luck. We had another troubled piece of property, and we sold it to someone. And I desperately wanted not to be in that asset. And the only thing that's better than selling that asset at a good value before values declined is if you get to sell it to your opponent and he gets to write it down, which is what we did. So it's a lot of work. You have to be really careful. There are lawyers involved with it, and you really need to know what you're doing. And we're not that smart. That's not a business we want to be in long term. But we've negotiated those to successful conclusions. Other questions? Okay, well, thank you for being here. We'll stick around a few minutes after the presentation here, and Mark will be around later today. If you have questions, one of the questions you guys have, if we give you more money, what are you going to do with it? Tune in to our investment committee calls, and you'll hear what we're talking about, why we're doing this, what we're doing. Thank you for being here.
Thank you.